In this week's market update, all eyes are on the Federal Reserve's final rate-setting meeting of 2018. Stock markets are spooked by more evidence of a Chinese slowdown, and a solution to the Brexit impasse looks further away than ever. Corporate news may be slowing down in the run-up to Christmas, but that doesn't mean there isn't plenty for investors to focus on in the final week before the holidays. Top of the agenda is Wednesday's Federal Reserve rate-setting meeting, at which the US Central Bank is almost certain to raise interest rates by another quarter point to between 2.25% and 2.5%. Far more interesting will be what Fed Chair Jay Powell has to say in his press conference about the outlook for further rate hikes in 2019. The most recent guidance from the Fed pointed to another 3 rate rises next year, but that's not a view shared by investors who expect a much more cautious approach in 2019. The odds, based on the prices in futures markets, of both no more rate rises and just 1 hike next year are neck and neck at more than 35% each. There's a less than 20% chance that there will be 2 hikes, and investors attribute almost no chance at all of 3 rises. This matters because US interest rates help determine the pricing of many financial instruments. They have a big influence also on the value of the dollar, and that in turn is a significant influence on other assets like share prices in emerging markets and the cost of commodities like oil and gold too. The most recent comments from Mr. Powell said that US interest rates are now just below neutral. That was taken as an indication that the Fed is getting ready to use this week's meeting and press conference to manage expectations towards a more cautious approach after 3 years of rising interest rates. As recently as October, Mr. Powell was suggesting that rates were some way off the neutral level at which policy neither stimulates nor constrains activity. This week's meeting will be scrutinised closely for a couple of reasons. First, because President Trump has been unusually outspoken in recent days in his criticism of the Fed's monetary policy approach. He's variously described the Fed as out of control, crazy, and his biggest threat. It's extremely unusual for a president to criticise the Fed chairman in this way, let alone a Fed chairman who was nominated by that president. He first started criticising the central bank when the stock market, which he views as a barometer of his success, began to wobble in October. This week, he ramped up the offensive, inevitably via Twitter, saying that he was surprised that the Fed was even considering raising interest rates again this month. His full tweet said, "It's incredible that with a very strong dollar and virtually no inflation, the outside world blowing up around us, Paris is burning and China way down, the Fed is even considering yet another rate hike." The second reason that investors will watch the Fed closely this week is the message being sent by the bond market, which is increasingly flagging economic trouble ahead. With the gap between the yields on short and long maturity bonds narrowing sharply, investors are watching anxiously for short rates, which are determined by interest rates, to rise above long rates, which reflect expectations for future growth and inflation. This so-called inversion of the yield curve tends to foreshadow an economic downturn or recession. It's been a reliable signal in the past, and it looks imminent. The outlook for US interest rates is one of 2 things troubling investors this week. The second is what is happening in the Chinese economy, which is showing worrying signs of slowing on the back of tighter credit conditions at home and worries about trade overseas. Retail sales figures on Friday showed growth at its slowest pace for 15 years in November, while factory output was at its weakest for 3 years. Both numbers suggest that recent efforts by Beijing to revive flagging growth are failing to gain traction. Although China was keen earlier in the year to rein in credit to cap high overall levels of debt in the Chinese economy, it's recently started to worry that it can't address borrowings at the same time as fighting a trade war with America. Evidence is mounting that Chinese consumers are starting to rein in their appetite for spending, with sales of big-ticket items like cars going into reverse. China has been the world's leading car market for 9 years now, but the latest data tell a different story. China is looking at the first decline in car sales since the 1990s, as car purchase subsidies come to an end and poorly performing stock and property markets undermine confidence. Collateral damage from this slowdown is being felt all over the world. Just this week, Jaguar Land Rover said it might have to lay off 5,000 workers as it attempts to counter a slowdown in sales. It's been hit by a triple whammy of flagging interest in diesel cars, less demand in China, and the cost of retooling its business for a less favourable post-Brexit world. The slowdown in China coincides with the 40th anniversary of the introduction of market reforms in 1978 that effectively set the country on its remarkable recent growth path. On this day, 40 years ago, Deng Xiaoping, China's leader, announced a dramatic shift in approach from the politically focused Cultural Revolution of Chairman Mao to a more economically focused approach aimed at lifting China out of its then grinding poverty. The success of the new policies introduced in 1978 is well known. Less clear is what might happen over the next few years, as the current leadership under President Xi Jinping takes the country on a more Maoist, inward-looking and in some ways repressive direction. The poor performance of the Chinese stock market is a combination of many factors, but it reflects in part anxiety about the direction the global economy is taking away from the open globalization that has been so helpful to China's development. It's not just China's stock market which is worrying about China. The S&P 500 ended last week on yet another weak note on the back of the Chinese data, and the US market picked up where it left off yesterday, closing another 2.1% lower to hit a 14-month low. Wall Street has now registered a series of lower highs and lower lows since peaking at more than 2,900 at the end of September. At today's level of just under 2,550, the US market is firmly in correction territory, having lost 13% since its high in September. Smaller US companies have fared even worse, with the Russell 2000 index now more than 20% lower and therefore in bear market territory. Last night's weakness spilled over into Asian markets, with Japan's Topix down 1.7% to hit an 18-month low. Closer to home, investor nerves have all been about the deepening political and constitutional crisis that Brexit is turning into. Last week's developments included the abandonment of a planned vote on the withdrawal treaty from the EU, a failed vote of no confidence in the Prime Minister, and growing momentum for a second referendum, which could ultimately see the abandonment of Brexit altogether. This week, another attempted vote of no confidence in Theresa May from Labour leader Jeremy Corbyn failed to even get off the ground, as the Prime Minister challenged her opposite number to launch a full-blown vote of no confidence in the government. Now, in more normal times, this series of events would be seen as a major political crisis. We've become so inured to bad news on the Brexit front, however, that no one seems particularly surprised at the latest chaotic turn of events. Despite calls from MPs to allow them to vote on the withdrawal deal before Christmas, Mrs May said yesterday that the vote will not take place before the 14th of January. She is determined to return to Europe to seek further assurances on the backstop insurance policy that's designed to prevent a hard Irish border, and which is the biggest sticking point in the unravelling Brexit story. There is, however, no evidence that she'll be any more successful over the holiday period than she has been thus far. As usual, the brunt of the political chaos is being borne by the pound, which is trading close to a 20-month low at $1.26. But the stock market is also suffering from dwindling risk appetite among investors. The FTSE 100, at close to 6,740, is down more than 1,000 points from its high in May of just over 7,900. Now, while that might sound like a gloomy way to end the year, the silver lining of the UK's unloved status is that it has not looked so attractive to contrarian investors in a long time. With the FTSE 100 yielding almost 4.5% and blue chip shares costing only 11 times expected earnings on average, the UK's blue chip index is offering an interesting entry point for any investor who can look through the current Brexit uncertainty.